Good afternoon. We'll just wait for a couple of minutes to let all participants join in, and we'll start. Okay, good afternoon. My name is Ajay Nair, and on behalf of ASK Investment Managers, I welcome you all to the first knowledge series on ASK products, beginning with our flagship, the ASK Indian Entrepreneur Portfolio. Today, we have with us Mr. Sumit Jain. He is the Deputy CIO at ASK IM with around 17 years of experience in Indian equity markets. He was actively involved in the conceptualization of the IP strategy and currently manages the largest single strategy AUM in the country of over $2.5 billion USD. He has also been instrumental in building the proprietary valuation models at ASK. And Sumit is what we call a true ASKite, having joined us in October of 2005 and has played a pivotal role in the growth journey of the firm. So today we've scheduled an hour for this webinar, where I would request Sumit to cover the broader trends in the market for about 15 odd minutes, followed by a deeper understanding of the ASK IP strategy, giving an insight of what happened in CY 22, where do we stand now, and how we see things going forward. This would be followed by Q&A. So I'd request all of you to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So Sumit, thank you so much for joining in, and all over to you.
Thank you, Ajay. Good afternoon, everyone. First of all, let me thank you all for joining in. The way I plan to cover is first talk about what the philosophy is. And philosophy is pretty important because that's the guiding principle. And that's the way we kind of invest into Indian markets. Then we'll take you through what our thought process of economy is all about. And then we'll talk about how is the portfolio positioned, what has happened in CY 22, and we'll take questions thereafter. So I'll start off with the philosophy piece first. So essentially, what do we do? I mean, when we look at any business, what are the things that we look at? Essentially, we look at four things. First and foremost, what is the size of opportunity? That's very important because that's the fulcrum under which the business operates. And how would this size of opportunity play out over next many years? So we look for opportunities which are very secular, opportunities that will keep growing year after year after year. And India offers multiple opportunities in multiple areas. So we look for opportunities which are not necessarily one time, but more something which is compounding in character. That's something very important to us. Second thing that we look at is all about quality of business and quality of management. Clearly, governance play a very important role. And consequently, if you are aligned with right promoters, that's very important from a sustainable value creation. And that, when coupled with buying a very high quality business, essentially would mean that here you are buying a business which is solid and looking at it from 3, 4, 5, 7 year perspective. What do I mean by quality of business? Essentially, it is the final number probably would be ROCE, but this ROCE denotes multiple things. A superior ROCE, and that is sustained over a long period of time, essentially would mean that business has developed certain advantage, certain moat that cannot be copied so very easily. So that is very important for us to really say that here is a business where opportunity is large, quality of business is something we are very comfortable with, quality of management is something that we are very comfortable with. And if these things are right, over period, what we get is a sustained earnings growth. And when that bought with a reasonable margin of safety, that leads to a decent value creation over a long period of time. When we do that consistently year after year after year, the outcome would be lower churn. And if you look at our portfolios as well, we have had a very low churn in the portfolio, I mean, varying between 15 to 35% across a 5-7 year time frame, with average being between 20 and 25%. Now, let me take you through what are the overarching principles that we kind of focus on. First and foremost is the certainty of earnings versus mere quantum. Certainty and consistency actually to us are far bigger virtue than short-term earnings growth, which may be slightly higher as well. So that is a very important aspect that we would look at. A long period, consistent and a sustainable earnings growth, not necessarily which is one time. Second aspect that we look at is, or rather we really believe in, is buying a business which is superior, buying a business which is sustainable, and even though that may be available at fair prices, to us, buying that is far superior than buying an inferior business, even though that may be available at arithmetically cheap prices. Because we believe that time is a friend of superior business, while it is an enemy probably of the inferior one. Because today the world is pretty dynamic, it keeps changing. And that is where if somebody is buying an inferior one, chances are pretty high that he would be hitting up with some amount of air pocket probably in future. And that would mean the ability of inferior business to really come back is a lot lesser as compared to the one who is far more able, building a business which is far more sustainable. So we believe that buying a high quality business is far better than buying an inferior one. So that this is in a way our philosophy is. IP is an offshoot of this philosophy. Before I come to Indian entrepreneur portfolio, let me talk about what is our view or how do we look at economy at the current point in time. So see, I mean, if you look at newspapers today, or if you look at economies at the current point in time, we keep hearing of multiple negative news flows, right? While I may have written only few, there are multiples that are kind of talked about. While some of these may be topical, some are kind of more long-term as well that we need to kind of think about. So first and foremost, while I'll cover inflation aspect in a while, inflation is a big concern, and we keep talking about whether this inflation is transitory, this inflation has topped out, or how would it play out over next few quarters. But clearly, there is a huge debate that's going on. We really believe that it's moderating at the current point in time. Second thing is the whole aspect about where the economies world over are kind of progressing. And slowdown is a given. Some believe that global economy will head into recession, but that's not the forecast by IMF. Right? Third aspect that is worrying, and that will change the whole geopolitical equation going forward, and that would have significant implication on investments as well, is all about war in Europe. That's kind of changing the whole game. Today, incidentally, it's 1 year of the time that Russia has kind of attacked Ukraine. And also, post-pandemic, we have seen how economies after economies have tended to increase their debt on the balance sheet. That all these are pretty worrying factors. Not only these, but structural aspect that is very important to look at is globally population is starting to age out. We have seen how things have played out in Japan, then in US, and now China as well is kind of starting to see aging population. India is among few countries where population is young, aspirational, and looking for significant improvement in the standard of living. So I can clearly say that the population aspect, demographic aspect, India is clearly well placed as compared to many other parts of the world. So now let's talk about how the growth rate aspirations or growth rate expectations have been. Clearly, the world is expected to see a slowdown in calendar year 23. Emerging markets, while may not look as a whole, may not look to be a lower number, but this is on an expectation that China will show an improved number. Other than that, emerging market is also expected to slow down. So growth is not a certainty. In that environment, India clearly should be one area where we should see reasonably higher growth. Now, let me talk about inflation, which is a worrying aspect.
Just sorry to interrupt. The slides are still not moving. If you can just
sorry, which page are you on?
We're on the main market outlook page.
Just a sec. Give me a moment. Can you see the slide now?
Yes, we can.
Sure. Thanks, Ajay, for this. Let me now talk about inflation as to how do we see inflation. See, clearly, inflation has been one area of negative surprise, especially after COVID. And after COVID, what we saw was goods economy kind of doing well and commodity prices going through the roof. And later on, services inflation being kind of sticky. So today, what's happening is what we believe is inflation has started to turn. And for better, we believe that we may be closer to peak inflation, given the fact that multiple drivers of inflation, whether it is commodity prices, whether it is supply chain, whether it is real estate prices, in many cases have already started to turn favorably. And which is why we believe that multiple factors of inflation have started to turn, and consequently, inflation creating an impact for the world economy may be a bit limited. While it is difficult to argue how fast would we start to see inflation starting to go down. So that is one aspect that needs very close monitoring. But clearly, Fed fund hike has been one of the fastest that we have seen over last multiple years. So that is one aspect that we have seen. And from here on, what we believe is quantum of rate hikes should be lower as compared to what we have seen over last many years. Now, why do I say that inflation probably is peak? Because if you look at multiple commodity prices, they are already off pretty sharply from their highs. Base metals is down very sharply. Agri commodities is something that we need to kind of look at, because what's happening globally is the climatic conditions have become pretty erratic, and consequently we may see foods inflation running relatively higher. But given the fact that base commodities are down, oil is down, energy is down, the inflation may not be a big worry. So oil is already down 33% from its highs. And if you look at the prices, which is more supply chain related, this is a very important aspect, because pre-COVID, what was happening was, if you were to look at freight cost from China to US, this was around, for a 40 feet equivalent unit, this was between $2,000 to $3,000. That post-COVID actually inched up to $22,000. It's now already down about 80% plus 88%, and now back to the earlier lows. So clearly, this indicates two things. One, while on one side, we are seeing goods GDP kind of normalizing. On other side, supply chain is also kind of normalizing. And this has multiple connotation. I'll come to that in a while with respect to how would it mean for our portfolio companies. But clearly, this has implication on inflation, cost of raw material, and cost of finished goods as well. Right? Agri commodity prices may be down 17% from highs, but they are still high on a year-on-year basis. And this is something that we need to clearly watch out for. In this global aspect, I would say India has done a reasonably good job. While external account is something that has been under pressure, Trade deficit is sharply negative, and that has led to widening of CAD. But clearly, Indian rupee has held on relatively well so far. If we look at our forex reserves, they went to the lows of $525 billion. They have inched up by about $50 billion from their lows, but at the current juncture, we kind of cover 8 months of import at least. So we are so far reasonably poised, I must say. But one thing that has changed over last many years is the composition of IT exports and oil imports. IT exports over last multiple years have been going up in a very linear fashion, while oil imports have been very erratic. So today our total IT imports or total IT exports are pretty close to oil imports. So to that extent, we are significantly better placed as compared to what we used to be in the past. So that is one very important aspect. Now let's look at how the economy is at the current point in time. So if you look at GST collections, we have been above 1.4 lakh crores for a while. I mean, for multiple months, we have been at that number. This essentially means two things. One, there is significant amount of compliance. And second, economy is also growing at a pretty decent pace. If you look at PMI indicators, anything above 50 points to expansionary phase in the economy. So clearly we are, whether it is manufacturing PMI or whether it is services PMI, both are kind of at a pretty decent pace. Another aspect which talks about how economy is doing at the current point in time is all about diesel consumption. And that talks about the real coincident indicator. And that's running at about 8-9% in terms of growth rate. So pretty decent, I would say. And over and above that, if you look at credit growth, at about 15-16%, clearly shows that the traction in the economy continues to be reasonably well. And within credit growth, not only retail credit continues to do really well, it's running at about 18-19-20%. Industry credit is also running at a pretty decent pace. And within industry credit, all the aspects, whether it is SMEs, whether it is large corporates, both are kind of doing reasonably well. So our confidence on Indian economy actually kind of, while overall growth rates may not be very high, but we would still be better placed as compared to many other parts of the world. That's the way we think about Indian economy. And see, what's happening apart from this coincident indicator is also about rural economy. For a while, rural economy has been under stress. But at the current juncture, what we are seeing is winter crop to be, or winter sowing to be reasonably normal. We are seeing a bit of a growth there. That coupled with increase in agri-commodity prices would mean that farm income should be reasonably well this year. Not only would farm income be well, decent, non-farm income as well, whether it is dairy prices or other things, they are kind of giving us confidence that consumption part of the economy, at least from the rural side, is doing well. Even on the urban side, the current quarter may give one picture, but we have to take current quarter with a pinch of salt because it has not been a normal quarter. I'll come to that in a while, but it has not been a normal quarter. We believe that discretionary part of the economy is a very long-term theme and that should continue to do well. Over last 10 years, what we have seen is consumption basket doing really well. Now, what we are seeing is manufacturing cycle also getting better. Not only China plus one is pushing up investments, but clearly clearly Europe plus one is also coming up. So to that extent, we are seeing a lot of export-led growth in chemical businesses, engineering businesses, auto ancillary, and PLI is further kind of driving this. So clearly, manufacturing-led economy is one area where we are kind of focusing a lot more on. And when manufacturing does well, the whole ecosystem starts to do well. Not only would the final product do well, you would see consumable businesses doing well, you would see logistics businesses doing well, staffing businesses doing well, employment kind of increasing. So to that extent, this is something that was of a very utmost importance. And this is happening at a point in time where all the three balance sheets, whether balance sheets of household, balance sheet of corporates, balance sheet of banks, all three balance sheets are in reasonably good shape. So the setup is in place in terms of we delivering at least 5 to 7% GDP growth from a long-term perspective. Now let me talk a bit about flows as to how FII flows have been. Last year again was a unique one. We witnessed outflows to the tune of almost $17 billion from FII perspective. This was, I would say, fourth year where out of last 20 years where we saw FII outflow. India is one country where we would continue to see long period growth. So to our mind, this is something which we believe is more temporary rather than permanent. So we would not be too much worried of how, or rather short-term or CY22 outflows because of FIIs. One interesting aspect that we saw last year is continued SIP flow, SIP flows, and they are running on a monthly basis at about $13,500 crores. So pretty decent number, and we believe that this kind of number actually can continue. Now let me talk about ownership, how ownership has played out in Indian context. And if you look at ownership, Indian promoter ownership in Indian market has been on a continued rise. From 31-32%, this has increased to 35% now. Retail ownership has also increased. Government ownership has come down a bit. And at the same time, FII, as we have seen, they have seen outflows. And to that extent, there has been some downtick in their ownership. So we are very positive that these are not shorter term trend. The focus of Indian entrepreneurs should mean that Indian promoter ownership in Indian market should actually continue to inch up. And this is function of their value creation as well. So this is one area which is very, very positive. Now let me take you through how has IEP portfolio been positioned in the current context. We are investors who would focus on secular themes. We would like to buy into businesses where opportunity is pretty large from a long-term perspective. And so where are the areas where we are kind of significantly invested into? First and foremost is the financials. We are significant or relatively higher weight in NBFCs as compared to banks, because the way we think about it, while calendar year 22 has been about banks, or for that matter, if you look at credit growth, anything that had to go right with respect to these financial institutions, most of the things have actually gone right. Whether it is credit growth, whether it is margin expansion, whether it is all about how things are playing out on the provision front. So banks have been one big beneficiary last year. What we believe is cost of deposit for banks will start to now catch up. And NIM expansion is something that we need to watch out for very closely. And that is where NBFCs should be relatively better placed from here on as compared to what they were in calendar year 22. And consequently, we have a relatively higher exposure towards NBFCs. Within financials, we have NBFCs, we have banks, and obviously we have insurance, which again is a very, very under-penetrated in country like us. And that should, growth in that area should continue for many years. Consumption, we are more focused on the discretionary part of the consumption, because we believe that as income level in India increases, as their aspiration kind of we can see, which is significantly high, discretionary part, premiumization led businesses should actually continue to do well. So we are significantly highly overweight on retail businesses. See, these are all distribution oriented businesses. A distribution network in India cannot be built so very easily. So any new player who enter into this area will take a lot of time to really make a dent into these businesses. So which is why the focus is not necessarily on consumption. Focus is what kind of distribution network have these businesses built, and that gives them that durable advantage. And we have seen how over a long period of time, these businesses have created value. So that is one large area of focus. Another large area of focus, as I was talking about, is also about manufacturing. And when I say manufacturing, we really believe that supply chain globally is kind of changing. So manufacturing in India for India and manufacturing in India for the world are incidentally the two themes that we are focusing on. So there may be manufacturing in India like APL Apollos of the world, or manufacturing for the world like chemical businesses. So these are two areas where we are relatively more focused on. And that's the way this portfolio is kind of built on themes which are more longer term rather than more one time in nature. Now let me take you through portfolio psychographics. What does it talks about? It essentially means that if this portfolio were to be one single stock, what is the character of this portfolio? We anticipate earnings growth to accelerate for the portfolio companies next year. And that would mean the gap between our portfolio earnings growth and index actually should be higher next year. Why is it not happening this year? See, there is a very interesting aspect that played out. Calendar year 22 was all about multiple variances. Incidentally, exactly a year back when we saw Russia attacking Ukraine, lot of commodities actually went up dramatically. And most of those companies which had very solid balance sheet actually stocked up significantly higher inventory. And over period, they had, because commodity prices went down, we saw inventory losses within those businesses and margins got impacted. So logically, some amount of earnings, as we start to see normalization in their margins, they have actually got shifted to FY24. And consequently, we believe that earnings growth for our portfolio companies should accelerate next year. Not only earnings growth is high, capital efficiency is also pretty superior. Index would be closer to about 15-16% ROC. Our ROCs are like 30%. So dramatically different ROC. And we believe that when character of the business changes, valuations don't change linearly, they change geometrically. And that is where PE also may optically look high, but we really focus on cash flows. And on price to cash flow front, they may not look as expensive. So over period, in fact, these businesses have become a lot more attractive as compared to what they were in the past, given the fact that there has been an earnings delivery, but market cap compounding or value creation has not been that high. Now, let me take you through how have the performances of our businesses been in this quarter and 9 months. In this quarter, we saw operating profit growth of 20% for Indian entrepreneur portfolio companies, while for benchmark, this is closer to about 12%. So there is a perceptible gap. In 9 months, obviously, this gap is relatively higher. But this is about shorter term. We really believe that the whole thought is to buy into businesses where earnings compounding is higher for a much longer period of time, and that is where the whole edge of ASK IEP portfolio lie. So this is the performance of ASK IEP portfolio. If you look at the performance of IEP on a calendar year basis, CY22 would have been the second year where IEP portfolio actually underperformed. CY12 was the first one. CY22 is second. In 13 years history, these have been rare instances. And we really believe that this is more one-off because of the character of businesses that we have invested into. Incidentally, in any crisis in the past, we've seen that the ability of our businesses to really bounce back, really increase market share when markets become a lot more normalized is relatively higher. We have seen that how it played out at the time of demonetization or at the time of taper tantrum or even at the time of GST implementation. And we believe this time is again not going to be different. Now, let me take you through, relatively bit more granularly as to why has there been some bit of underperformance on CY22 numbers. So first and foremost, if you were to think about concentration of returns in benchmark, it has been a very peculiar year. Top 7 businesses contributed to all the returns in the benchmark. If you look at Nifty or if you look at BSE 500 or for that matter, if you look at BSE Midcap Index as well, top 7 were all the businesses who contributed more than 100% of the returns. Within that, if one were to dissect those as per the ownership pattern, again, CY22 has been very peculiar. Family-owned businesses actually performed the worst. All the other ownership pattern, whether it is professionally owned business, whether it is multinational corporations, whether it is PSUs, they did better than family-owned business. And these are not many instances in the past. If one were to look at recorded history, let's say 100-year history in US, over a long period of time, family-owned businesses tend to really do much better than other ownership pattern. That's simply because they are far more agile. They have their own skin in the game. They are the ones who identify sunrise sectors pretty early on, and their execution is dramatically superior than many a times dramatically superior than other ownership pattern. And that is where our whole confidence on Indian entrepreneur portfolio lie, and that has been the basis of the creation of IEP portfolio itself. So as I said, since CY22 was a year where family-owned businesses underperformed, it has had some impact on CY22 performance. Now let me talk about how has it been on industry allocation versus stock selection. What did well in markets in the last calendar year? Businesses like utilities, businesses like auto OEM, businesses like contracting construction businesses, they actually did, or even for that matter, PSU defense businesses, our under exposure towards those businesses led to bulk of the impact. Our stock selection effect contributed to almost 30% of that underperformance. So all through last 13 years, we have been focusing on how our businesses perform versus the marketplace. So our under allocation or under indexation to industries which actually performed in the marketplace has been a bigger drag on the performance as compared to the stock selection effect. Within stock selection, it has been concentrated among 3 or 4 businesses that has led to the underperformance. And we believe that every year there has been cases where some stocks do underperform, but over a long period of time, if those businesses kind of continue to deliver on to earnings growth, continue to deliver on to capital efficiency, returns do follow. And that is where the whole focus is. And we are very confident that given the way these businesses are performing on the marketplace, real market, we don't see significant need to change our portfolios. And consequently, our churn in CY22 also has been pretty limited. Yeah. Ajay, I'm open to questions that the audience may have.
Sure. Thanks so much, Sumit. I mean, I can see a lot of questions already getting raised. So let me just maybe start off with the first one. Multiple queries that the investors have raised right now, actually from both buckets of clients who've been with us for 5 to 7 years, as well as clients who probably come in the last year or so. And everything stems around the question of maybe the older performance having somewhat of the gross returns getting reduced, and some setting on negative performance. So the first question really stems is, how do we address this query? And maybe let me just try and link other queries coming in. So you mentioned 30% stock selection in terms of impact on performance. So a lot of queries are coming in with regards to stocks like a Divi's and Aarti Industries, Sona BLW, Metropolis, which probably have contributed to the underperformance. If you can also share your thoughts on the same, linking both the questions together.
Sure. Let me address the longer term performance first. See, I was talking about how the performance has been of IEP on a calendar year basis. While the underperformance of CY22 is having a bearing on 3-year and 4-year performances as well. And we really believe that CY22 is more a one-off year rather than a recurring one. And there has been factors which are something I would say more one time. And given the fact that these businesses are performing well on marketplace front, the confidence is high. But if I were to relate it with selection effect, let me come to businesses which have actually led to the drag on the performance. First business is Divi's. See, Divi's is one business that we have held on for many years now. What is the strength of the company? It works with large innovator pharma companies on the CRAMS side. They are one of the lowest cost producers of multiple APIs globally, right? At the current point in time, what we are seeing is global API cycle is under stress, and which is why Divi's have also got impacted. But this doesn't take away their long-term capability. In fact, once that cycle revives, Divi's will benefit dramatically. But that is just one part of the whole story. Second part, which is a very interesting piece and a relatively higher margin business, is custom synthesis. They work with large innovator pharma companies on the custom synthesis side. And especially after COVID, the work on R&D side actually got delayed. And this is leading to a bit lagged impact on DVs. So we believe that the impact on performance is more temporary. Nothing takes away the strength of the company, and long-term growth with solid capital efficiency is something that is we are very confident of delivery by the company. Second is which actually led to a bit of underperformance last year or selection effect has been Metropolis. Why did we get into Metropolis? If you were to think about the opportunity there, it is an opportunity into the whole space of transitioning from unorganized to organized as well. As the standard of living gets better, as the pharma industry or healthcare industry kind of gets organized, the scope of expansion of organized player actually increases dramatically. That's one. Second is, if you look at the business from an age profile perspective, as people crosses certain age thresholds, the need to go to diagnostic actually goes up, right? And also business is moving towards, or medical science is moving towards more evidence-based, I would say, treatment. So to that extent, Metropolis is beneficiary of all the trends that are playing out. What happened in the meantime is, the whole thing got postponed, in the sense there was a pricing pressure from new age players, and that led to some bit of impact on the business. We already started to see pricing by the competition or pricing by new age players starting to go up, and business should start to get better from here on. We are keeping a very close eye on how this is kind of playing out. And if you look at their non-COVID business in the quarter gone by as well, they delivered almost about 13-14% growth rate in the non-COVID side. And we really believe that this kind of growth rate should kind of continue from here on. This is a very interesting business. Growth rates are going to be average, but a very high ROC business. I mean, 30-40% plus ROC. And that people thought that while this is high ROC business and capital light, it's easy to get in. So that is true. But while entry is easy, it may be capital light, but certainly this is not an energy light business. So to that extent, the ability of new players to really increase profitability is something that we'll have to kind of see. Right? And in the meantime, you already started to see how pricing has started to kind of inch up from the lows. Right? So we are kind of watching this business pretty closely, and we'll take appropriate call as we see the environment kind of changing. Now, let me take you through the third business which led to the impact on selection effect is Sona Comstar. Sona Comstar actually is a play on, before I come to Sona Comstar, let me talk about how this industry itself is evolving. See, auto industry is one industry where there is a change that's happening from the technology perspective. So those businesses which are on the right side of technological curve should benefit dramatically over next many years. Whether world moves towards electric vehicle, whether world moves towards hydrogen cells, whether world moves towards plug-in hybrid, time will tell. But clearly one thing that is evident is the inclusion of or usage of electronics in an automobile, right? As automobile become a lot more intelligent, the electronic part will actually increase dramatically. And Sona Comstar, half of the business is about electronics. The balance half is about differential assembly, which caters to, I mean, that's form agnostic. It caters to electric vehicle, while electric vehicle is ramping up, and that is where they are kind of doing well. But it caters into multiple form factor. And we believe that here is a company that has ability to grow 20% plus for many years. The visibility on growth is very high. They have order book, which is multiple times their revenue. And consequently, we remain steadfast on the business. Yeah, Jay.
Thanks, Sumit. Again, a very stock-specific question which is coming in. And Patanjali seems to be a common thread across all our questions. Why do we have Patanjali? So I'm just reading a question here. Why do we have Patanjali Foods in our portfolio? Would love to hear your views there as well, Sumit.
Sure. See, Patanjali is a foods arm of the Patanjali Group. So while they are into other areas as well, but here is a company which focuses on oil and which focuses on all the aspects of food, whether it is biscuits, whether it is noodles and other aspects, honey as well. What has attracted us into this business is significantly higher growth on the food side. Right? We believe that this business should grow on the food side at least 15% plus for next many years. And what is it going to be driven by? It's going to be driven by deep penetration. I mean, this is one company which has built penetration right into the hinterland and continuing to do that. This is among very few brands which got built over last 15 years. I mean, you can count on your fingertips how many new brands would you have seen in terms of creation, right? So new brand creation talks about the execution prowess of the group. The whole focus on hinterland and significant expansion there would mean that they would continue to get penetration-led growth. And they are the one who kind of revived Ayurveda back into the country, right? So we believe that foods will continue to grow. Oil business is something which is more of an cash cow. That should grow not more than 5-7% in terms of profitability. So these are two aspects that we have actually focused on. But more than that, they are also developing a business which is more into palm oil plantation. We may not see growth in that business in the short period of time because it takes multiple years for you to see kind of growth there. So we would see dramatically bigger numbers in next 5-7 years time frame. And we are not counting so far in our assessment at the current point in time. But all this is being built in a very capital efficient manner. We believe that business should deliver ROC upwards of 13%, significantly higher cash flows, and very clean balance sheet. So that has attracted us to Patanjali in the portfolio.
Interesting, Sumit. Another question that is coming is that all markets have been volatile through the year. What changes in the portfolio have we done in the recent past? And how do we believe that can aid growth for the portfolio going forward?
Ajay, we are always focused on longevity of growth. And we continue to monitor each of our businesses pretty closely. The fact that our portfolio earnings growth, or rather, it stacks up relatively well, even at the current point in time, the need to change portfolios dramatically has been very limited. Incidentally, what we have seen in the past as well, that whenever there has been crisis, the portfolio actually has bounced back. And why have it has bounced back pretty sharply? Because the character of those businesses have been such that their ability to increase market share across varied business environment has been high. And we continue to see that across most of our businesses, even at the current point in time. And consequently, portfolio churn has not been very high. You would have seen only 2 name change in the portfolio last year.
That is true. Just linking another question to this, although we keep talking about this quite regularly, is that again due to volatility and expecting that commodity prices will inch up during the beginning of the year. Just clearly talking about this line, that why do we not take active cash calls in the portfolio?
See, you talked about commodity prices. Let me address that first, while that has not been asked. And then we'll come to cash call. See, if you look at commodity prices, right, they have come down. Most of our businesses actually are consumer of commodities and seller of branded goods, right? So to that extent, most of our businesses actually have reasonably higher pricing power. And while that pricing power cannot be displayed on a very short-term basis, but over period, we have seen that how they have been able to extract incremental margins, right? And that is what we have always focused on. And if we remain with such kind of businesses over a long period of time, there is a value creation which is significantly superior. And which is why we don't want to take cash call. We want to deliver superior returns by our stock selection skill sets. And there has also been learnings of the past that it's always important that we don't look to time markets. We don't look to take significantly bigger cash calls, right? Always, it's a good idea to focus bottom up, focus on businesses. In all markets, we'll find businesses that are doing well. And over a long period of time, while they may not get rewarded appropriately when times are not so great from market perspective, but all businesses get their due respect over a long period of time. And which is why we don't want to take cash calls.
Got it. A very interesting question which is being raised. It speaks about mostly high growth companies started building inventory in 2022 during the Russia-Ukraine war, post which, due to high inflation and increase in interest rate demand, did not move as expected. However, middle of the year, we did anticipate that interest rate will remain sticky. Hence, why did we continue to stick with the high quality, high growth space?
See, in markets, it is always important to focus on businesses from or rather earnings growth and capital efficiency, not necessarily from a very near-term perspective, because that's virtually known to many. The difference comes when we can project long period growth, because today that is the arbitrage. Time is the arbitrage that is there with many of the asset managers, right? So to that extent, we are ready to live with volatility in the short period of time. Businesses don't function linearly. If the impact on earnings is more shorter term, many a times we see that their ability to come back is significantly higher. Because competition gets impacted pretty sharply. Let me give you an example. If you think about a business like pipes, PVC prices dropped pretty sharply, but the performance of the business that we own has been significantly better than their competition. In many cases, competition was down or negative even at operating profit level, right? So while our business was also down in terms of profitability, it increases its long-term capability, it increases its long-term attractiveness. And which is why we don't want to sacrifice a business because of short-term impact on earnings, which is more one-time in nature rather than a recurring.
Sure. There's a question from Mr. Ankur Pagaria, who asks that, we believe that insurance will do good over a longer period of time. But in the recent budget, we had the new taxation policy which came in. And maybe just linking a Bajaj Finserv to that as a position in our portfolio. How do we perceive maybe both the Bajaj twins to really perform going forward?
See, Bajaj Finserv is a combination of four things actually. One obviously is Bajaj Finance. And if you look at the growth rates there, it continues to stack 25% plus. We really believe if you look at their market share at the current point in time, they are at about 1.5% of the total credit in the system, right? Can they be relatively higher in terms of market share over a long period of time? We reasonably believe so, right? Can they be 2.5% over next 3, 4, 5 years? Chances are pretty high. For that, they are kind of continuing to get into new areas and continue to, whether it is products or geographies, right? And that has been their model as well in the past. So we really believe that here is a business which has superior ROE. Their ROE today is upwards of 20%, 23, 24%. And growth is also superior, right? How many lending institutions would one can find out where ROEs are so superior, and the longevity of growth, at least from next 3, 4, 5-year perspective, is also high, right? So we remain focused, we remain pretty positive on Bajaj Finance. That's one part of Bajaj Finserv. Other two parts of Bajaj Finserv are the two insurance business. One is the life insurance piece, second is the general insurance piece. And if you look at life insurance, that's a relatively smaller part of Bajaj Finserv. It's a business that is kind of getting into trajectory at the current point in time. And we believe that the journey for Bajaj Life Insurance has only started. It's too small in the overall scheme of things. They are a reasonably larger size player on the general insurance side and one of the most profitable ones. They used to have, at the current point in time, combined ratio may not be, is closer to about 100%, but they used to have about 94-95% combined ratio. Very few insurance companies in the country has had combined ratio, or rather underwriting also as profitable piece. And the fourth piece is all about new businesses that the Bajaj Group is trying to develop, whether it is the health piece or the other pieces that they are marketplace as well that they are trying to develop. So Bajaj Finserv actually is not necessarily insurance. It is combination of multiple pieces on the financial services side, and each of them are pretty unique, and credit goes to them in terms of building a business in a very, very capital efficient manner and yet being very mindful of the growth. And which is why we have both the businesses, whether it is Bajaj Finance or Bajaj Finserv.
Thanks for that, Sumit. Another interesting question which has come in is that, can we state the FPI outflows as one of the reasons for the performance numbers into the stocks? And if you look at the valuation arbitrage between China and India, which was fairly higher earlier, coming down, can we expect the flows to come back? And maybe linking ASK there, would we have a positive impact on our portfolios?
See, FIIs have been negative, and they had a reasonably larger exposure to most of the businesses that we own. Whether the underperformance is because of that, we'll have to really see that. But what's happening is, I structurally believe that FIIs is something flow that may not be negative from a long-term perspective. Because India is one growth market, which is large, liquid, and India offers significant policy stability. And which is why, while shorter term, we may see more flows into China, but that may not be very structural. Because that aspect is something that's really missing there. And India, if you were to look at the performance within the emerging market basket, India has beaten most of the countries hands down over long period of time. And I don't see any reason why that should change. Clearly, FII selling has had an impact to a certain extent on the performances as well. And we'll have to clearly focus on earnings. And if they continue to deliver well, whether FII is coming or not, whether DI is coming or not, markets find its due place over a long period.
Yeah, completely agree. Very happy to see a question here. You mentioned about, although they say that have you seen underperformance in the portfolio historically? So you did mention that in CY12 we did see an underperformance coming in there. And further, maybe just linking the first question of underperformance, would it be an appropriate time to really look at ASK portfolio at the current juncture? Or would it be an appropriate time to really add money in these portfolios? And how do we, what sort of growth are we anticipating from the underlying portfolio businesses overall?
See, as you rightly said that we saw underperformance in CY12. Intermittently as well, we have seen underperformances during course of the year in the past as well. And every time we have seen high quality business bouncing back very sharply. And from that point onwards, risk-adjusted returns actually look much superior, right? And today may be one such time where there is earnings growth. We anticipate earnings growth to accelerate, at least in FY24, but that's more one-time phenomenon. Longer term, our businesses, or the whole idea is to invest into businesses which have that strength, right? Which have that longevity. And consequently, if these businesses don't grow significantly higher than the nominal GDP over a long period of time, in terms of earnings with a very superior capital efficiency, it doesn't make sense to invest into those businesses. So always idea has been to focus on the growth part of the market, because over a long period of time, growth delivers value. Right? Growth delivers value creation. And there always has been debate between value and growth. We generally don't think about it that way. We really believe that when there is growth, there is value, right? And I really believe that when there is continued growth and those businesses underperform, those are always good time to look at this portfolio.
Yeah, just a clarification which people have sought is that you mentioned that there's be a slowdown in terms of worldwide slowdown in 2023, and you're saying that the FPIs will be positive in India. If you can just elaborate on this statement of yours.
See, 2023 may see slowdown. I mean, those are IMF estimates, and what those are being discussed as well globally. There is significant amount of uncertainty clearly, and risk is more on Europe and more on developed parts of the world. If you look at emerging markets aided by China, we may not see a slowdown. In terms of flows, I believe really difficult to say whether we would see positive flows necessarily in the short period of time, but structurally you have not seen many times in the past where FII, in fact, we have not seen any time where FII flow in India has been negative for 2 consecutive years. If you look at last 20 years of history, FII flows have been negative only 4 times, and all at different instances. So if one were to just apply that history, or if you were to look at India's own growth profile, there is no reason for us to believe that why should FII flows not be positive. Whether it happens in CY23 or CY24, we'll have to see that, but structurally flows should be positive in the country.
Thanks for the clarification, Sumit. Just last couple of questions, which I can see as a common thread. One is again coming in, it's more stock specific, coming in for stocks like both Dixon and Page Industries. So would like to hear your views in terms of what's happened in the last this current financial year, and again the way forward in terms of what we see there.
Sure. Let me talk about Dixon first. See, Dixon is a play on EMS, electronic manufacturing industry in the country. And if manufacturing in the country were to grow, multiple aspects will actually grow over next many years. And we are too small in the overall scheme of things. Dixon this year should have revenues close to about 12,000 crores, right? So pretty small. While it may be largest in the country in the whole EMS piece, but relatively smaller in the overall size of opportunity perspective. And we really believe that growth rates here will be significantly higher and for a much longer period of time. Not only would that be the case, that will be backed by ROCs which are upwards of 30%. Still, what led to the underperformance in the name? Especially in Q3, what happened was one of the business, which is largely mobile, actually saw a bit of slowdown. And consequently, there was a negative, or rather a disappointment on the numbers, and that has led to sharp slowdown or sharp drop in the price. Does that take away the capability? Not necessarily. In fact, over period, today the anchor customer for Dixon is Motorola. Over period, they would kind of have a lot more customer in this area, and that's the way EMS industry evolve. You evolve from one player to second player to third player to fourth player, and that is what we have seen them doing in each of their businesses, whether it is lighting, whether it is consumer durable or other businesses. So that's an evolution, and stock has been hammered because of the underperformance on the mobile piece, right? But long-term growth, we are fairly confident about it. Having said that, we are closely watching as to what kind of growth should we anticipate from this company. So that is one area. And second business that you talked about is Page Industries. See, what has been the hallmark of the company? It's about getting into adjacencies. This is one area that we keep focusing on in most of our businesses. Page may be just one. So the ability of management to get into either the same geography with the new product or tap into new customers or whatever, right? So ability to get into adjacencies would allow them to cater to a significantly larger size of opportunity. We have seen how it played out in Havells. They kind of went from cables to motors to fans to lighting products to small consumer durable appliances to large consumer durable appliances, right? Essentially to the distribution network, right? So keep increasing your size of opportunity. Same thing happened with Page Industries as well. From a men's innerwear to women's innerwear to kids wear to athleisure to swimwear, multiple areas over period is what they have gone into, and in turn delivering on to above average growth for last many years with a very sustainable margins. So that has been the hallmark. How did they do that? They kind of focused onto the distribution network. They focused on the MBO network. They focused on exclusive business outlets, right? That's very important. Very few companies in the country has been able to kind of build EBO network the way Page Industries has built. In the short period of time, in the quarter gone by, we have seen slowdown in this entire space. Is that slowdown permanent? Not necessarily, right? We really believe that this is more a temporary phase of this slowdown, and generally in any business you see slowdown for a few quarters before they kind of consolidate their position and they kind of come back pretty strongly, right? Incidentally, if you look at other players in this area, they have actually performed much worse. The bottom line for those businesses have dropped between 70 to 90% in this quarter gone by, right? While in case of Page, it has been dramatically better than the peers. And if we keep focusing on businesses where opportunity is large and growing, and he is increasing market share long period, you kind of tend to see significantly higher earnings growth. That has been the focus, and Page is no different.
Thanks, Sumit. Just the last question on the portfolio specifically. People are asking as to why we are switching to Bharti Airtel, although you did cover that telecom piece, which historically has been highly capital intensive. Does it meet our ROC requirements if we really talk about it?
So see, Bharti is a very interesting one. Clearly, this is an industry which wherein Bharti and Reliance both have been gaining market share. Not only are they gaining market share, they are also seeing shift from 2G to 4G, and ARPU, average revenue per user, is also kind of increasing. Right? After a length of time, we have, while we may not have seen price rise in the short period of time, but incidentally, ARPU for telecom companies have increased sharply from the lows, right? So there are multiple drivers for the growth of revenues, and these are businesses where bulk of the incremental growth of revenues translate to profits. But this time there is going to be one change. While companies are investing into 5G, we believe that capex intensity will still not rise very sharply. And consequently, after a length of time, cash flow growth will be significantly higher. So the way we see it is, if revenue grows at X%, operating profit will grow at X plus, cash flow will grow at X plus plus, and once confidence on that cash flow growth increases, value creation will be X plus plus plus. So that is our thought on the whole telecom space. In fact, this should apply not only to Bharti, but to the telecom business of Reliance as well.
Perfect, Sumit. There's this one question I just saw it right now, and we've answered it multiple times, but I just want to ask it a different way. Would it be safe to assume that the worst is behind us for the portfolio?
Sorry, would it be
safe to assume that the worst is behind us for the portfolio in terms of what we've seen?
So see, all I can say is earnings are tracking well. We anticipate earnings growth there. Capital efficiency is not being diluted. Markets are markets, right? Don't want to really say what happens from a short-term perspective, because they always keep surprising you, right? And always throughout, if we focus on right businesses, outcome will be much superior than what we anticipate.
So thank you again, Sumit, for your detailed thoughts on the portfolio. And actually, after hearing you, I do believe that the experience of our investors will be back to how it was earlier. A sincere thanks to all the participants on this call for showcasing faith in ASK. Our endeavor would be to connect with you regularly and keep sharing the updates through the year. Specifically with regards to this call, we would be sharing the recording link of this call to your email address. And once again, thank you all for joining in today. This concludes the session for the day.
Thank you for joining.
Thank you, everyone.
Thank you.